What we'll be talking about today is the role Romanian risk could potentially play in the global insurance and reinsurance industry. So worldwide, we have a significant challenge right now as risk bearers, and that is, how do we deploy capital? Throughout this presentation, you'll see that one of the challenges that stretches from Zurich to London to New York to Bucharest to Hong Kong to Singapore is that there isn't enough risk making it into the global market, and that creates a shortfall of risk and an abundance of capital. Some of the folks that I recognize here in the audience are acutely aware of that and what it means for cash drags, hitting target return on equities, and so forth. So the solution to all of this is frankly original risk. If you're unfamiliar with the expression, original risk is essentially that new risk that enters into the global insurance and reinsurance risk and capital supply chain for the first time. That first policy, that first pad policy that comes into PIDE, all right, that's later reinsured, that's later turned into a retrocessional transaction, that may be consumed by an ILS fund with pension capital. It all starts with that first original risk, that first pad policy. Original risk is the only real, genuine way to grow the global insurance and reinsurance industry. Sure, there are some opportunities to maybe launch a new line or find some incremental cost improvement in a mature market. There are plenty of opportunities to do what one does well better. But the returns that are possible are limited, especially when it comes to improved efficiency rather than original risk. Improved efficiency is inherently constrained. You can't cut past zero, which means your upside is limited. On the other hand, you look at all the uncovered risk in the world right now, and there was a great slide earlier today that talked about economic versus insured loss worldwide using the Swiss Re numbers. You don't have the same constraints with original risk that you do with efficiency. This is what fuels growth up and down the risk and capital supply chain, and it will always be more valuable than the incremental gains attainable in mature markets. So the global market needs original risk badly, and these are two of my favorite charts from the reinsurance industry. The first is the Guy Carpenter Global Rate Online chart, and what you can see is the peaks and valleys at the left that came with catastrophe events in the past, and as you go to the right, as time passes, those peaks and valleys get tighter. 1992, Hurricane Andrew struck Florida. It was a massive event. That's the first really big spike. The subsequent spikes you see are September 11th terror attacks, the 2004 Florida hurricanes, Katrina, Rita, and Wilma in 2005. And you can see that the spikes following those events are smaller, and they flatten out faster. And by the time you get to 2011, which was a major loss year for the world, you had, in particular, the Tohoku event in 2011. You look at 2012, which had Superstorm Sandy, which affected me personally. All right, there's hardly any movement in the global rate online chart. Reinsurance rates weren't going up and down the way they used to. And the chart on the right explains why. In addition to the sufficient reinsurance capital out there in the market, you've got the global pension fund community that wants access. And at the time of the chart, global pension assets were at around 30 trillion US dollars. That's since gone up to around 36 or 37 trillion worldwide assets under management. If they've got a target allocation of 2 to 3% to insurance and reinsurance risks, that means there's enough capital waiting on the sidelines that is effectively twice the amount that's currently deployed. That's a big problem that only original risk can solve. Let's get real. You're not going to absorb twice what's already deployed without significant worldwide change and without substantial new opportunity coming into the global market. So let's talk about Romania. That's why I'm here, you are here, and we've heard a lot about insurance penetration in Romania, the need to promote solutions like PIDE, and the benefits that come with having a protected public, a public protected by insurance. The last speaker clearly discussing Italy drove that point home. And we know that there are markets like Italy, like Romania, like California, that are heavily exposed to earthquake risk and are not sufficiently insured. So overall insurance penetration in Romania is slim, around 1.25%. On the mandatory homeowner property side, obviously it's a bit larger than that, but still quite underpenetrated, which has been a theme throughout the morning. On top of the 80% or so that could provide growth on the compulsory policies, you've also got potential growth in the voluntary market on top of that. So there's plenty of room to grow, and it's not just the 80% that's currently uncovered. Throw in commercial risks as well that could be covered more thoroughly or differently, and there's a lot of opportunity for insurance growth here in Romania. Insurance density's finally backed up past the 2010 threshold after having been down for a while, and there's the potential for insured values to grow. So in addition to increasing penetration, economic growth provides the opportunity to grow insured values, which also creates more original risk to come into the market. There are some challenges, of course, if you look at the Maplecroft scorecard over to the right. Maplecroft's one of our sister companies. There are some opportunities with access to financing that are currently constraining middle-class growth. Middle-class growth, of course, drives insurance penetration. So there are some headwinds to the sort of potential that Romania could provide. Nonetheless, sort out insurance distribution, drive awareness, insurance growth becomes possible. Insurance growth unlocks capital that people are currently reserving for their own use in the case of disaster. Insurance replaces that safety fund. That safety fund becomes consumer capital. Economic growth follows. So let's summarize Romania here. Currently a small insurance market, but it certainly does not have to stay that way. All indications are that Romania, in fact, could become a significant contributor of original risk to the global market. And the contribution of original risk, of course, drives growth for shareholders up and down the risk and capital supply chain. You got plenty of cat exposure here, which the global pension and alternative asset community wants to consume. There's an opportunity for economic growth that could drive further risk that could lead to capital deployment worldwide. But of course, there are some fundamental economic challenges that will have to be overcome. Interestingly, insurance can help alleviate those economic headwinds. So what is PCS? Why am I here? We provide cat loss estimates for industry-wide catastrophes in the United States, Canada, and Turkey. We're the only loss aggregation service that provides loss estimates for all natural and man-made perils. And frankly, we're looking at more ways we can deliver cat loss estimates to the global insurance industry. We're looking at new regions around the world. I'm sure you can guess why I'm here within this context. We're also looking at specialty lines and some other opportunities to provide these benchmarking tools that can be used for everything from evaluating your reinsurance submission through index-triggered alternative risk transfer. So ultimately, by knowing the size of a catastrophe loss on an industry-wide basis, and you saw some estimates earlier when it came to Italy, it gives you a sense of how the industry is affected, and it gives an insurer the opportunity to understand how they're affected. That can lead to improved negotiation with your global reinsurance markets, streamlined, more effective risk transfer, better capital management. And what does better capital management mean? Let's think back earlier to the solvency test discussions. Improved risk management protects solvency and ultimately helps address the standards that are being set worldwide. So what role do we play in market growth? By doing our one small task well, estimating the size of catastrophe losses. We provide more risk transfer alternatives to insurance companies around the world. Rather than just traditional reinsurance, traditional UNL, you have the opportunity also to diversify out of the traditional reinsurance system, thereby mitigating systemic risk by transferring risk to the capital markets. You can reserve more effectively, benchmark your average claim paid. You can make a better case to your reinsurers or other capital providers based on your performance during a cat. Or if your losses are disproportionately high, at least you'll know ahead of time so you can have your story together with your broker. Better understanding of historical risk helps you develop more effective products that are actuarially sound and competitively priced to drive future market growth. Mentioned Solvency II facilitation earlier. And also, at the end of the day, if you know your market, you know your losses, and you know what it means for your book of business, you become much more attractive to capital worldwide, which provides a significant opportunity to reward your shareholders and your customers. So what are the reinsurance industry's next steps here? All right, worldwide, we need to identify the sources of original risk that could drive financial growth for the reinsurance and insurance industry worldwide. Clearly, we believe Romania is an important one of those markets, especially within this region, especially with the long-term potential that we and our analysts have seen. Then the industry as a whole needs to collaborate. We got to work together. Working through a central source that can collect cat loss estimates, for example, you're now enabling an industry-wide tool that gives everybody the same fundamental competitive advantage. So you're not giving up an advantage that you have. Your advantage then comes from how you use that data relative to your peers and competitors. But if we don't all work together on this, we're all behind. So you think about it, a rising tide lifts all ships. That's the first step. The second step is what you do to get your ship a little bit higher. The reinsurance industry needs to then use this to bring new risk to market, deploy more capital, support local market development, to bring more risk to market, to deploy more capital, to generate the target return on equity levels that we used to see 10, 12 years ago. Thank you kindly. I appreciate your time.